If there's one thing Warren Buffett has taught us, it's that you make money in investing when you buy quality companies at a discount. But here's the kicker. Finding these bargains in today's overvalued US market is like searching for a needle in a haystack. Big names like Apple, Google, and Nvidia are at all-time highs, and price tags are through the roof. But what if I told you there's a market where strong companies are trading at significant discounts? A market where you can apply Buffett's value investing principles. That market? China. Now, here's the intriguing part. While Buffett himself has avoided making major plays in China, his best friend and longtime partner Charlie Munger has gone all in. And it's not just Munger. Other investing legends like Michael Burry are heavily betting on Chinese stocks. So what do they see that Buffett doesn't? In this video, I'm going to show you 5 most undervalued companies in China that perfectly fit Buffett's value investing philosophy. I will also show why Buffett has been hesitant to invest there, and what Munger and Burry know that could reveal major opportunities. Stick around, this might just change how you think about investing globally. Alright, let's get into what makes Warren Buffett the GOAT of investing. Value investing. If you've followed Buffett for a while, you know that his secret sauce is buying quality companies at a discount. He's always looking for great deals, high-value companies that the market has temporarily undervalued. So, how does Buffett spot these golden opportunities? Well, it's all about something called intrinsic value. In simpler terms, it's what a company is really worth based on its actual earnings and growth potential. The goal? Find companies where the stock price is lower than their intrinsic value. If you're thinking, well, that's easier said than done, you're right. It takes patience, research, and a lot of discipline. But if you nail it, you're essentially buying a $100 bill for $50. Pretty sweet, right? Now, here's where things get interesting. Right now, in the US market, finding these kinds of deals is getting tough. Stocks like Apple, Google, and Amazon are soaring at all-time highs, with massive price-to-earnings ratios. These companies are fantastic businesses, no doubt, but they're far from being cheap. Buffett's famous rule is, be fearful when others are greedy, and greedy when others are fearful. And let's be honest, people are pretty greedy in the US market right now. Here's the deal. While US stocks are pricey, Chinese tech giants like Alibaba, Tencent, and JD.com are trading at a fraction of their value. These aren't small unknown businesses, they're major players, dominating industries in China just like Apple and Amazon do in the US. And yet their stock prices have been beaten down for various reasons, mostly related to political and regulatory issues in China. But from a pure business perspective, these companies are still incredibly strong. Think of Alibaba. It's the Amazon of China, with fingers in everything from e-commerce to cloud computing. Or take Tencent, which practically owns China's entire digital ecosystem, with apps like WeChat and a massive stake in the global gaming industry. They're making billions in profits every year. The problem is not with their business models, it's how the market is currently pricing them. So if you're a value investor like Buffett, looking at China right now is like walking into a high-end store that's having a massive clearance sale. But there's a catch. Buffett himself has been reluctant to make big moves in China. Why? Well, let's dig into that. So why hasn't Warren Buffett jumped into China despite all the tempting opportunities? It boils down to one thing: risk. And if there's one thing Buffett is famous for, it's minimizing risk. Buffett's investment strategy revolves around sticking to his circle of competence. He's always said that he invests in what he understands, and for him, that's the US market. In the US, Buffett knows the rules, the economic environment, and how businesses operate. It's like playing a home game where the odds are in his favor. Fewer surprises, less risk. So when it comes to investing outside the US, especially in markets like China, Buffett usually takes a step back. But why China? As attractive as Chinese companies might seem, think of tech giants like Alibaba or Tencent. Investing there comes with a different set of challenges. One of the biggest red flags for Buffett is political risks. The Chinese Communist Party has a habit of stepping in and influencing private companies, which is a huge concern for any investor, let alone someone as cautious as Buffett. For instance, in 2021, Alibaba was hit with a $2.8 billion fine for antitrust violations, a decision made by the CCP that sent shockwaves through the markets. The government has the power to impose regulations at any time, and for someone who values stability, that's a deal breaker. Imagine holding a stock in a thriving company one day, and the next day, the government makes a move that causes your investment to plummet. For Buffett, that kind of uncertainty doesn't align with his long-term, low-risk strategy. Here's where Buffett himself explains this further, in a response to a question on why he hasn't invested more with China.
Hi, Mr. Buffett. This is Matthew Lai from China, Hong Kong. I'm running my listed listing company called FW, and we are so grateful that to learn from you, and you really inspire us. My question is, besides the electrical car company, BYD, under what circumstances you will reinvest and reconsider to invest Hong Kong and China company? Thank you.
Yeah. Well, our primary investments will always be in the United States. We do think it. Now, the companies we invest in the United States, American Express does business around the world, and no company hardly does business around the world like Coca-Cola. I mean, they are the preferred soft drink. You know, something maybe like 170 or 180 out of 200 countries. Those are rough approximations from a few years back, probably, but that degree of acceptance worldwide is, I think it's almost unmatched. I can't really think of any company that has it. American Express has a position in the credit card field, which I think is extremely strong. And part of that was part of the reasons for that is one of the directors that I introduced a few minutes ago, Ken Chenault. But it has strengthened dramatically over the last 20 years for a lot of reasons. So we will, the BYD investment was we made the commitment in Japan, which I did 5 years ago, and that was just overwhelmingly, it was compelling. It was just extraordinarily compelling, and we bought it as fast as we could, and we spent a year, and we got a few percent of our assets in 5 very big companies, but that's the problem of being our size. But you won't find us making a lot of investments outside the United States, although we're participating through these other companies in the world economy. But I understand the United States rules, weaknesses, strengths, whatever it may be. I don't have the same feeling for economies generally around the world. I don't pick up on other cultures extremely well, and the lucky thing is I don't have to, because I don't live in some tiny little country that has just doesn't have a big economy, but I'm in an economy already that has, after starting out with 0.5% of the world's population, has ended up with well over 20% of the world's output in an amazingly short period of time. So we will be American oriented. I mean, if we do something really big, it's extremely likely to be in the United States. Charlie, in all those years, there's only 2 times he's told me that, this one is really, he he would always go along with me and say, well, when I was suggesting something, he'd say, well, this is really not that great, but it's probably the best you'll come up with, so I'll go along with the idea. But Charlie twice has pounded the table with me and just said, buy. And BYD was one of them, and Costco was the other. And we bought a certain amount of Costco, and we bought quite a bit of BYD. But looking back, he already was aggressive, but I should have been more aggressive in Costco. It wasn't fatal that we weren't, but he was right big time in both companies.
This statement sums up Buffett's outlook perfectly. He is not interested in venturing into unknown territory when there's plenty of growth potential in markets he already knows inside and out. But it's not just about political risk. There's also the issue of VIE structures, or variable interest entities, which are common in Chinese companies listed on foreign exchanges. These structures allow foreign investors to invest in Chinese companies, but they don't actually provide ownership of the company. Instead, you own shares in an offshore entity that has contracts with the Chinese company. While this arrangement is legal, it's fragile. If the Chinese government ever decides to crack down on VIEs, foreign investors could lose out. For a risk-averse investor like Buffett, that's a serious red flag. Buffett's comfort zone remains in the US, where the rules are familiar and predictable. In one interview, he even admitted that the US market provides him with more than enough opportunities to build his empire. When he does step outside US borders, it's in rare cases where he feels extraordinarily confident, like his investment in BYD, a Chinese electric vehicle company. While Warren Buffett remains cautious about investing in China, his long-term partner, Charlie Munger, is charting a different course. Unlike Buffett, who tends to stay within his comfort zone of the US, Munger isn't afraid to explore opportunities overseas, especially when those opportunities align with classic value investing principles, and that's precisely what he's found in China. So what's Munger's angle here? Well, he sees China as a place where you can find quality companies at steep discounts, even when the rest of the world is shying away. One of his prime examples is Alibaba. Let's break down what makes Alibaba so attractive to Munger. Think of Alibaba as the Amazon of China, but it's even more diverse. From cloud computing and e-commerce to entertainment and digital payments, Alibaba has built a powerful ecosystem with multiple revenue streams. Despite all this, its stock price has plummeted due to regulatory crackdowns and market fears. Munger saw this drop not as a reason to panic, but as a huge opportunity. For him, this is the classic value investor's dream, finding a fundamentally strong company while the market has temporarily punished it. When Alibaba's price fell, Munger started buying shares for the Daily Journal Corporation, which he serves on the board. He's been vocal about Alibaba being absurdly cheap compared to its intrinsic value. But Munger isn't going in blindly. He's fully aware of the risks involved. In fact, he recently spoke on the topic, addressing the concerns head-on. Let's hear from Munger himself in a clip from a recent interview.
Just about China in general, I had a lot of questions that came in regarding that. I'll ask this one from Wilco Schutzendorf. It's coming in from Walnut Creek, California, who just said, previously you stated that despite certain shortcomings, China was generally moving in the right direction. However, with the recent actions taken by the Chinese government, such as capriciously punishing technology and educational companies, declining to import effective COVID vaccines, escalating threats towards Taiwan, do you still maintain that China is a viable investment option for foreign capital, or is China experiencing a similar regression as Russia has seen under Putin's leadership that culminates in the invasion of Taiwan?
Well, that's a very good question, of course, but I would argue that the chances in a big confrontation from China have gone down, not up, because of what happened in the Ukraine. I think that the Chinese leader is a very smart, practical person. And It doesn't. Russia went into the Ukraine and said it looked like a cakewalk. I don't think Taiwan looks like such a cakewalk anymore. I think it's off the table in China for a long, long time. And I think that helps the prospects of investors who invest in China. And the other thing that helps in terms of the China prospects are that you can buy better, stronger companies at a cheaper valuation in China than you can in the United States. So you're getting the extra risk can be worth running given the extra value you get. That's why we're in China. It isn't like we prefer being in some foreign country. Of course, I'd rather be in Los Angeles right next to my house.
Munger's response highlights his pragmatic approach. He acknowledges the geopolitical risks, but also sees the bargain in these valuations. For him, the rewards of buying high-quality companies at discounted prices far outweigh the risks, especially when you consider how inflated U.S. valuations are in comparison. Munger doesn't prefer investing abroad. He'd rather find these opportunities close to home. But, as he puts it, I can't find that many opportunities, right next to my house. This is the essence of his strategy. When the opportunities in the U.S. aren't as compelling, he's willing to look further afield, even if that means navigating a riskier market. While Alibaba is a prime example of Munger's strategy, it's not his only success story in China. Another standout is BYD, a company he has championed for years and one that Buffett eventually bought into based on Munger's conviction. BYD, often called the Tesla of China, isn't just an automaker. It's also a leading manufacturer of batteries and renewable energy solutions. To put this into perspective, here's a clip where Munger explains why he believes BYD is ahead of Tesla in the Chinese market.
Well, last year, what happened? BYD last year made more than $2 billion after taxes in the auto business in China. Who in the hell makes $2 billion who's a brand new entrant really in the auto business for all practical purposes? It's incredible what's happened. And so there is some of this old-fashioned capitalist virtue left in the Daily Journal, and there's some left in Berkshire Hathaway, and there's some left in BYD. But most places, everybody's trying to take what they need and just rationalizing whether it's deserved or not.
Charlie, you bring up BYD, so I'll jump to a question from Stephen Spencer, who writes in from New York, New York. He's curious why Mr. Munger prefers an investment in BYD to Tesla.
Well, that's easy. Tesla last year reduced its prices in China twice. BYD increased its prices. We're direct competitors. We're so much ahead of BYD. BYD is so much ahead of Tesla in China. It's like it's almost ridiculous. And if you look at BYD, which most people have never heard of, if you count all the manufacturing space they have in China to make cars, it would amount to a big percentage of all the land in Manhattan Island. And nobody ever heard of them a few years ago.
In Munger's view, BYD has not only established itself as a dominant player, but is outpacing Tesla in China. The company's ability to increase prices when Tesla is cutting theirs demonstrates the strength of BYD's position in the market. Munger sees this as a testament to BYD's competitive edge and scalability, two factors that align perfectly with Buffett's preference for businesses with strong economic moats. Even though Munger and Buffett take different stances on China, their core philosophies are closely aligned. Both look for companies with strong fundamentals, solid management, and long-term growth potential. The difference is that Munger is more willing to navigate the complexities and the risks of the Chinese market to access these opportunities. Make no mistake, Munger is no stranger to risk. He knows that investing in China comes with its share of challenges, from political interference to regulatory uncertainty. However, Munger sees these challenges as the price one pays for truly undervalued opportunities. He embraces the classic investing mantra, no risk, no reward. Now, we can't talk about big names betting on China without mentioning Michael Burry, the investor who famously predicted the 2008 financial crash. He's now betting big on Chinese stocks. Known for his contrarian approach, Burry is scooping up shares of major Chinese companies like Alibaba, JD.com, and Baidu, all of which have seen their stock prices drop due to regulatory and geopolitical concerns. But unlike most investors who see risk, Burry sees opportunity. Let's dive into the 5 companies that offer serious upside if you're willing to embrace a little risk for big rewards. When it comes to Chinese tech giants, Alibaba is probably the most well-known. Often compared to Amazon, Alibaba dominates e-commerce in China, but it's also involved in cloud computing, digital payments, and even entertainment. It's a massive company with multiple revenue streams, making it an ideal candidate for long-term value investors. So why is it undervalued? Regulatory pressures have weighed heavily on Alibaba's stock price over the past couple of years. The Chinese government fined Alibaba $2.8 billion for antitrust violations in 2021, and the stock has been struggling to recover ever since. But here's the thing. Despite all the noise, Alibaba's business fundamentals remain strong. It's still a highly profitable company with huge growth potential, especially in cloud computing, which is growing faster than e-commerce. From a value investing perspective, Alibaba is trading at a price-to-earnings ratio of around 10, compared to Amazon's PE ratio of over 50. That means you're getting a company with similar dominance and growth potential, but at a fraction of the cost. For investors like Charlie Munger, this is a no-brainer. High-quality company, low price. Analysts expect Alibaba's earnings to grow steadily over the next few years, with estimates pointing at a 15 to 20% increase in revenue annually. If the regulatory environment stabilizes, Alibaba could see a significant bounce back, making it a solid pick for long-term investors. Next up, we've got Tencent, another behemoth in Chinese tech space. Tencent is the digital ecosystem unto itself. If you've ever heard of WeChat, China's all-in-one app for messaging, social media, and payments, that's Tencent's crown jewel. But Tencent doesn't stop there. It's also one of the largest players in the gaming industry, owning stakes in companies like Epic Games, the creators of Fortnite, and Riot Games from League of Legends. Tencent has been hit hard by regulatory crackdowns, particularly around its gaming division, where the Chinese government imposed restrictions on the number of hours young people can spend playing games. This caused some short-term pain, but like Alibaba, Tencent's core businesses are still highly profitable and positioned for long-term growth. Right now, Tencent is trading at a price-to-earnings ratio of about 12, which is incredibly low for a company of its size and dominance. Its free cash flow remains strong, and it continues to expand in areas like artificial intelligence and cloud computing. Tencent is expected to see revenue growth in the mid-teens over the next few years. Its dominance in social media, digital payments, and gaming gives it a wide economic moat, making it a prime candidate for value investors looking for long-term plays. Now here's one that's near and dear to Warren Buffett himself, BYD, the electric vehicle manufacturer that's often called the Tesla of China. What's interesting about BYD is that it's not just an automaker. It also manufactures batteries and renewable energy solutions, giving it a broader scope than what most traditional car companies do. Buffett, through Berkshire Hathaway, has been invested in BYD for over a decade, and it's one of his most successful international investments. But despite its long-term success, BYD stock has seen some ups and downs recently due to the broader market concerns about the Chinese economy. However, BYD is well positioned to take advantage of the global shift towards electric vehicles and clean energy. It's not just dominating in China. BYD is expanding into Europe and Latin America, making it a global player in the EV market. The company sold over 1.5 million electric and hybrid vehicles in the last year alone, surpassing many of its competitors. Analysts are forecasting 25 to 30% revenue growth for BYDs in the coming years as the demand for EVs and renewable energy solutions continues to rise globally. With strong backing from both the Chinese government and international markets, BYD is poised to be a major player in the EV revolution. JD.com is China's second largest e-commerce company, right behind Alibaba. But here's the thing. JD has carved out a niche for itself by focusing on logistics and infrastructure, giving it a competitive edge over other e-commerce platforms. In fact, JD's delivery network is so efficient that it rivals Amazon's, which is no small feat. While JD's stock has also been hit by regulatory concerns and broader market fears, the company continues to grow. JD's investment in its logistics network gives it a moat that's difficult for competitors to break through. And because JD handles its own deliveries, it has more control over the customer experience, which has led to higher satisfaction rates and customer loyalty. Right now, JD.com is trading at a price-to-sales ratio of around 0.5, which means the market is severely undervaluing its revenue potential. For value investors, that's a signal that JD is a diamond in the rough. JD's revenue is expected to grow in the low double digits over the next few years, driven by the expansion of its logistics network and increasing consumer demand in China. With its strong infrastructure, JD is well positioned to weather any short-term regulatory storms and continue growing in the long run. Last but not least is the NIO. If you're looking for a play on the electric vehicle market but missed the boat on Tesla, NIO might be the next big thing. Often referred to as the Tesla of China alongside BYD, NIO is an electric vehicle startup that's been making waves with its sleek designs and innovative technology. NIO has faced some challenges recently, including supply chain disruptions and rising competition in the EV space. But despite these hurdles, NIO continues to grow. In 2023, the company delivered over 120,000 vehicles, and it's expanding its lineup to include new models like the ET7, a luxury electric sedan that competes directly with Tesla's Model S. One of NIO's most interesting innovations is its battery swap technology. Unlike Tesla, which focuses on charging stations, NIO has developed a network of stations where drivers can quickly swap out their batteries for a fully charged one. This could give NIO an edge in the EV market, especially in countries where charging infrastructure is still developing. NIO's revenue is expected to grow by 20 to 25% annually as demand for electric vehicles continues to rise. While the stock has been volatile, NIO has the potential to become a major player in the global EV market, especially as it expands into Europe and other international markets. Buffett may not be actively investing in undervalued Chinese stocks, but he is certainly advising people to exit the US market. Click the video on the screen to learn why.